Good morning, everyone. Welcome back to our Growth Funds event. In a few minutes, we will be hearing from George Barrow, co-manager of Pillar Capital Global Financials Trust. This isn't perhaps a classic growth area, but we think there are two reasons that make this portfolio very interesting at this current time. First is the rather obvious rates environment, and we've already heard from the Fed yesterday. They've begun to taper QE, and we will hear shortly from the Bank of England, as some of us are expecting them to begin raising interest rates. Clearly, that is a strong tailwind for financials. But secondly, within the trust itself, there's some exposure to some interesting growth areas, such as emerging markets, such as Fintech. And clearly, the market in general agrees. The trust is trading on a 2.2% premium as of yesterday's close. Before I hand over to George, I would just like to remind you that if you wish to ask a question, there is a box which should be on the right of your screen. I will collect those questions. We'll have a roughly 20 to 30 minute presentation, and then we will put your questions to George. So with that, I will hand over.
Thank you, Thomas, and good morning, everyone. Just to give some brief background on the trust, it's one of three funds run in the financials team at Polar. It was launched in 2013 as a way for investors to get global diversified exposure to the financial sector with both an income and growth mandate. It's historically paid a yield of close to 3%. The trust invests globally across all financial subsectors and across large to small caps. There is a 100% tender offer every 5 years at NAV less costs, and through both recovery in markets and issuance of shares, the trust has grown and now has a market cap of around £480 million. In terms of performance, on page 3, the trust has outperformed its benchmark since inception, and the relative performance has picked up since the corporate action last year. It's also outperformed the Lipper peer group. We've put the UK banks in the table, not because they're a particularly difficult hurdle, but just to really highlight the importance of taking a diversified approach to investing in the sector. So whilst UK banks have seen a pickup in performance recently, over the longer term, performance has been weak. And again, to us, highlights the need to have taken a global approach to investing in the sector. So as a brief summary of the investment case, so whilst there has been a recovery in the sector, valuations remain attractive, particularly relative to the broader market. They remain key beneficiaries of the reopening trade. So as COVID fears recede, economic activity picks up. The sector has seen strong earnings growth, earnings upgrades to both this year and next year's earnings, primarily on improved asset quality trends, but also small upgrades to pre-provision income. Capital return is a key theme, and we're now seeing high yields as regulatory restrictions are lifted. And finally, the sector is a prime beneficiary of high rates, and we'll discuss that in more detail later on. So this slide looks at the relative performance of global banks versus the broader market in both the global financial crisis on the left and what we've seen over the same period during the pandemic over the last 18 months or so. What's interesting to us is that whilst we have seen a strong recovery recently in the sector, banks have underperformed broader markets to a much greater extent than during the financial crisis. This is despite much more resilient operating trends today. So whereas back in the financial crisis, you had banks issuing highly dilutive capital raises, today you've quickly seen the sector returning to paying high dividend yields. Now, to some extent, the difference in performance could reflect a change in the makeup of the market, with growth sectors like tech and healthcare a larger component. But it's important to note that the sector today is in good health, offering high yields, much improved regulatory visibility, and the prospect of higher rates to support earnings. And with that, relative valuations are only back to their pre-COVID lows. So looking at asset quality, the left-hand chart shows US bank non-performing loan trends and highlights the contrast between this cycle and last, with NPLs rising only modestly last year and being on an improving trend for the last 3 quarters. Now, asset quality has clearly benefited from state support schemes, whether that's the furlough scheme in the UK or the Paycheck Protection Program in the US. So unemployment was lower than it otherwise would have been. But it's really important to note that the sector had de-risked ahead of the downturn. So relative to the global financial crisis, credit controls were much tighter, capital was stronger, and loan growth was at much lower levels going into the downturn, always a key indicator of future stress. Looking at the right-hand chart, which looks at loan loss reserves on the balance sheet, it's important to note that the level of loan loss reserves remains higher than pre-pandemic levels, around 30% higher, despite reserve releases the last few quarters. Now, to some extent, that reflects regulatory changes, but with the sector well reserved and asset quality improving, managements have guided for continued reserve releases next quarter, so that will continue to be a tailwind to earnings as those reserves are released. Now, turning to a subject that remains hotly debated, the outlook for inflation. Now, because of the unprecedented nature of the crisis, the visibility on the longer-term trajectory of the recovery has been quite limited. So until around mid-September, market consensus was inflationary pressures were transitory, driven by temporary supply chain bottlenecks and stimulus measures that were set to fade. We felt that there are actually increasing signs of more durable inflation if you look at areas such as housing, shelter costs, if you look at wage growth. US wage growth in the third quarter increased at its fastest pace since 2004. And then in terms of longer term trends, the consequences of COVID likely to be a shift to more regionalization versus globalization to better control supply chains, and also the increased focus on climate change and an economic transition to a green economy, we also think will have longer term consequences for inflation. So we're not surprised there's more recently been a re-evaluation of the inflation outlook. So turning to rates, as the left-hand chart shows, inflation expectations have risen, but the correlation with the 10-year has broken down, potentially due to questions on longer-term growth outlook, central bank willingness to let inflation overshoot target levels. We see scope for yields to rise further. We had the Fed taper announcement yesterday. We think inflation is set to remain elevated, and with yields, we think, set to rise as we approach the first rate hike. We've put the Fed dot plot on the right-hand side, which points to potentially the first rate hike towards the end of next year. In terms of correlation, so with bank earnings positively geared to higher rates, as you can see on the left-hand chart, they are the most correlated in terms of share prices to rising bond yields. And as highlighted in the right-hand side, we can see the correlation to growth sectors such as tech and healthcare is relatively low. Banks have a pretty low correlation to these sectors and so provide diversification for investors with growth portfolios and some insurance should inflation continue to rise. While banks are a beneficiary of a steeper yield curve, they're much more sensitive to a rise in short rates. So around 2/3 of the earnings upgrade will come from the short end rather than a steepening in the curve. As the right-hand chart shows, for US banks, on average, 100 basis points rate increase would increase their earnings by about 13% in year one, and that same rate rise would increase earnings by around 20% in year two as more of the loan book gets repriced. Now, as the chart shows, there is quite a large variation by bank depending on the structure of the balance sheet, and the trust bank exposure is more weighted to the higher rate sensitive names. It's also important to note that consensus earnings doesn't yet capture the benefit of higher rates in their estimates, as analysts have yet to put through higher rates into their models. So with Fed futures now pricing in around 2 hikes next year, we expect consensus to shortly reflect this. So regarding the question of stagflation, while we do see the potential for inflation pressures to persist, we're not convinced that this will inevitably be accompanied by a period of stagnating growth. Both household and corporate balance sheets remain very healthy, and we expect corporates to utilize elevated cash levels to support growth and lead to an increase in capex. Similarly, as the graph shows, household deposit levels have increased significantly during the crisis, suggests consumers are in a strong position to raise spending. And as the graph on the left shows, debt service ratios remain at historic lows. So we feel consumers would be able to manage a modest rise in rates without impacting sentiment and spending materially. Turning to balance sheets, a key message from this slide is that bank capital materially stronger than it was in 2008. And importantly, banks have built capital during this downturn, and we now have visibility on longer term capital requirements. So a more stable regulatory environment than we saw after the last downturn. This is a key difference in the situation post the financial crisis, where we went through a prolonged period of regulatory tightening, which acted as an overhang on the sector. Turning to capital return, with capital return restrictions now lifted, we're seeing banks return to a high level of yield. The ECB and the Bank of England were the last to lift the dividend ban and buyback in September. We've subsequently seen high yields being paid. So on average, US banks are yielding just in excess of 5% if you include both buybacks and dividends. And a number of our European holdings are yielding in excess of 10% as catch-up dividends are paid from the last 2 years. We feel given the levels of surplus capital, with managements being explicit in their intention to run down surplus capital to minimum to their target levels, we think yields are expected to remain elevated, not just this year, but also in future years. In terms of growth trends, loan growth at large cap banks has been at pretty low levels, so sort of low single digits, but we are able to find high levels of growth in both emerging markets and at US small and mid cap banks. On this slide, we've put the third quarter year-on-year loan growth for our US small and mid cap holdings in the trust, which highlights strong growth for a number of our holdings. For those focused on a particular segment, for example, so Silicon Valley Bank, the bank on the right, lends primarily to the technology sector, loan growth of over 40%, or they can be focused on a particular region or economy within the US. So on average, our US mid-cap holdings had loan growth of around 20% year on year. Importantly, managements have guided for activity to strengthen towards the year end, so we would expect a high level of loan growth to continue to drive earnings. Given loans and revenue mix for these types of banks, they're also relatively highly geared to interest rates and remain a key overweight for the trust. Turning to other parts of the portfolio, emerging markets represents around 20% of the trust. The majority of that is in emerging Asia. Structurally, this is an area we remain positive on, given low levels of penetration. EM financials often a very attractive way to play the rise of the consumer, but at a material discount to pure consumer stocks. We typically own high quality private sector banks such as HDFC Bank in India or BCA in Indonesia. These are banks that have shown an ability to grow book value across multiple cycles, continue to generate attractive ROEs. We generally don't invest in state banks. We don't have any exposure to Chinese banks where transparency can be lacking. You typically have a state bank lending to a state corporate, often on non-commercial terms. Having reduced our EM exposure earlier this year due to macro headwinds in Asia related to COVID, China tightening, slower vaccine rollout, more recently we've been adding to our holdings as the reverse has happened. We've started to see COVID restrictions being eased, activity picking up, and we're taking advantage of some of the valuation opportunities that have opened up. Moving to fintech, it's around 7% of the trust. This is an area that we're spending increasing amount of time looking at and researching. Our fintech holdings are primarily within payment companies such as PayPal and MasterCard. We have a preference for fee income type fintech rather than balance sheets type fintech. And having taken our fintech weighting up during the crisis last year to around 15-16%, we've subsequently taken profits this year following what was a significant re-rating. So stocks like PayPal and Adyen rose over 100%. So given valuation considerations, we have taken some profits, and that's freed up room to add to more of the cyclical parts of the portfolio, such as the banking sector. Overall, though, this remains a very interesting area for the sector, and we'd expect longer term this to be a growing portion of the trust. In terms of the insurance sector, it's 14% of the trust. That's biased towards non-life insurance. Companies such as Chubb, Sampo and Arch, diversified businesses with good underwriting track records. We also have life insurance exposure through AIA. The non-life sector has been affected by concerns related to COVID losses, so areas such as business interruption they've also faced elevated catastrophe losses this year. However, the pricing environment has improved, as you can see on the left-hand chart, albeit the pace of those improvements has moderated in recent quarters. The non-life remains useful in terms of portfolio construction, so less sensitive to macro cycles, and we think there is strong capital to take advantage of improved pricing trends. However, we are underweight the space as we feel banks are the most attractive way to capture that cyclical recovery and the higher rate environment. So turning to valuation, as you can see on the left-hand chart, we have seen a recovery. So global banks recovering to around book value. As you can see on the right-hand side, whilst banks have recovered, they've only recovered in terms of relative PE back to their pre-COVID low and continue to offer attractive upside. And just in terms of rate sensitivity, to give an example, 100 basis points rate rise would raise Bank of America's return on equity by about 280 basis points. The upside would rise around 30%, and the price to earnings would fall 300 basis points from 15 times to 12 times earnings. So that just gives a sense of how material it would be should analysts start to put through rate rises into their forecasts. So looking at the correlation between the starting price to book and your forward 3-year returns, we're currently just above book value, the red dots on the screen. Historic correlations would suggest around 30% forward returns from the starting point. Now, there is a clear split between the pre-financial crisis multiples on the right and the post on the left. We think there is room for multiples to shift a bit more towards the right-hand side. So whilst ROEs for the sector have compressed, as banks now hold significantly more capital, the return on assets they generate is only slightly reduced. So if you have a lower risk sector with higher capital, paying high yields, and a similar level of underlying profitability, all else equal, you should see a lower cost of capital applied. I think investors were unwilling to give this benefit until they'd seen how the sector performed through the next downturn. We've now had that happen with this pandemic. The sector's proved to be resilient, so we think we'll see more of this sort of argument come through. We've also done an exercise looking at the last 9 crises going back to 1990 to look at how the sector performed on a relative basis since the market low. So on average, as you can see on the bottom right, the sector has outperformed by 23% over the subsequent 12 months from the market low. From the COVID low in March last year, the sector outperformed by around 4%. So again, whilst we did get a recovery, it wasn't as strong as we'd seen in previous crises. We think there is room for further outperformance given where we are in the economic cycle. So this chart says it all really in terms of growth versus value investing. So value investors look away now. The last 10 years have been quite painful. And as the chart highlights, the extent to which growth has outperformed during a period of declining and low interest rates. So we're back towards a sort of dot-com era in terms of growth as a proportion of total index. The recent rotation to value has slightly changed this chart. So the dark blue line at the bottom has increased, but only to around 19%. So we think there is room for more reversion, particularly if we get a further reevaluation of the longer-term interest rate outlook. So as a quick summary of our holdings, the banking sector remains the key overweight at around 65% of the trust. The US is the largest geographic exposure at around 45%. The bulk of our EM exposure sits within Asia, and we look to keep our UK weighting below 10% to give that global diversification for investors that might already have 1 or 2 UK financial holdings. The trust is currently 7% geared as well. So in summary, we continue to view an attractive outlook for the sector. We think it's well positioned to benefit from economic reopening and recovery as COVID fades. It's now offering high yields and would be a key beneficiary of high interest rates coming through and supporting earnings. Importantly, it also offers diversification from growth sectors that have re-rated in a low-rate environment. Whilst we have seen recovery in financials, again, they are only trading at their pre-pandemic lows in terms of relative valuations. So with that, Thank you very much for your attention, and happy to take any questions.
Thanks very much, George. We have a few questions already, but please do use the Q&A function, and we'll try to get through all of them. So you spoke a bit, George, about the capital return story for European banks. Could you give us some examples, perhaps, and what exactly the plans are, how they're going to reward shareholders?
Sure. So in terms of capital return, we've now had clarity, as noted, that they've lifted the restrictions in terms of the ECB and the Bank of England. So a number of banks are paying catch-up dividends and have significant levels of surplus capital. If we take an example today, so ING reported their third quarter results today. They have a 15.8% core tier 1, and they intend to reduce that down towards their target level of 12.5%. So the excess capital that they're carrying is equivalent to around 20% of their market cap. So if you add to that the 50% dividend payout from earnings, it suggests a total yield of around 10% is achievable over the next 3 years. Another example I'd give is Banca Generali, which is an Italian wealth manager held in the trust, which continues to show strong AUM growth. So due to excess capital, it intends to pay a catch-up dividend of around 9.5% yield. Guidance for 70-80% payout ratio gives you another 5% yield. So you can see a number of European banks yielding well in excess of 10%.
And why do you think that sort of historically European banks have struggled to create shareholder value compared to global peers?
Yeah, I mean, I think there's a number of factors. I mean, they've had obviously a low rate environment, which has put pressure in terms of their top line. They're also, you could argue, being overbanked, so there's a requirement for consolidation within a number of markets. And they need to also take greater measures to control and reduce their cost base. Doing all of that during a time in which regulation has been ratcheted up since the financial crisis. So they've had cost pressures related to compliance and regulation during a time of declining loan growth and low rates. So all of those have been headwinds that have been acting on their revenues. I think from a balance sheet point of view, they've got to where they need to in terms of capital. They are taking action in terms of improving costs. So a good example would be the Nordic banks, where a bank like DNB has reduced its branch network by 80%, maintained its low market share, and improved its cost efficiency. So they are taking actions in terms of costs. Now, obviously, if we remain in this low rate environment, that continues to be a headwind for earnings. We think NIMs are sort of bottoming at about this level, given where rates are. But should we start to get any move up in rates, they are particularly sensitive to that. So a 100 basis point rate rise for European banks would increase earnings by about 24%.
In terms of stepping to the emerging markets, I mean, this is 20% of the portfolio at the moment, 21%. It hasn't been a great year for Asian economies and China in particular after a fantastic 2020. Do you think there's signs of a turnaround in sentiment? And if so, what stocks in the region stand out?
Yeah, so we have seen some headwinds on EM countries this year. So whilst last year they showed relatively good containment of COVID, if we're thinking about North Asia, they benefited from strong technology-related exports. This year we've seen more macro headwinds. We've had more COVID restrictions introduced across a number of countries during a time in which China has been tightening its policy, and that's affected regional growth. I think regarding China, we do remain cautious and underweight. We think there's probably further to go in terms of them looking to rebalance growth, deleveraging the property sector, which could continue to weigh on growth. But we are seeing a pickup in activity in a number of other countries. So India, Indonesia, Thailand would be good examples of that, where we've seen COVID restrictions being lifted in the late summer, and more recently we've seen economic activity picking up. We've seen month-on-month improvements in terms of loan collections. And so an example would be, more recently we've been adding to HDFC Bank, one of the sort of prime private sector banks in India. continues to show strong operating trends. So 2% ROA this quarter. It's growing its loan book at 16% year on year, continues to take market share. The stock has lagged a bit because of concerns about temporary regulatory restrictions on credit card lending. We think those will fade, and it remains very well positioned to take market share in what is a very attractive banking market. You have 2/3 of the Indian banking market controlled by state banks, which are capital constrained. Then you have very well-run private sector banks, which continue to take market share. So it's a market that we like, and we think that the stock looks well positioned to grow. Another example would be Thailand. Again, we're seeing COVID restrictions ease. We think it's a very good play in terms of reopening trade. We've started a position in a company called Sritawad, so a Thai consumer finance lender, which had derated on COVID concerns and regulatory impact on asset yields. We think it's now looking very well placed to accelerate its lending, and it has a very high level of profitability with an 8% ROA. So we think it's a very good way to play the reopening of the economy. So it has been a challenging year for EM. We have taken down our exposure earlier in the year to reflect that, but more recently we are seeing more opportunities open up.
And in terms of the fintech weighting, so you've had a question why you have a relatively low weight given the sort of the growth-like returns in that area of the market. Why have you not, like some of your peers may have done, why have you not invested more in that sector?
Yeah, I mean, I think it's a good question. We are seeing obviously fintech enter all segments of the sector. Having said that, the actual investable universe remains relatively small. I think right at where we are in the economic cycle, we think the greatest opportunity remains within sectors such as the banking sector. So, we are seeing strong earnings upgrades related to interest rates. We think valuations remain attractive, seeing a pickup in terms of economic activity. We think that remains the most interesting sector. But having said that, we will likely to raise our fintech exposure at some point beyond that. So it's just a reflection of where we are in the economic cycle and sort of the risk reward that we see within the two. But a number of our fintech holdings have also re-rated significantly. So having taken our fintech exposure up to 16% last year, valuations have got to pretty high levels. We've taken some profits on those to reflect where valuations have got to. So it's a sort of balance of where we are in terms of the cycle, what valuation opportunities that we're seeing. But clearly this is an area that we're dedicating more time to, and we are seeing more opportunities to invest. We would expect it to be a growing proportion of the trust going forward.
So we had a question around a couple of questions around the rate rises that we expect. So I think they go well together. So one of them is asking what are the potential risks to banks of rate rises, and secondly, what if central banks simply can't raise rates as much as they would like to for fear of tipping the economy back into recession? In such a scenario, how would the most interest rate sensitive financials perform versus the highest quality earnings financials? What would it mean for the sector?
Yeah, I mean, they're very, very good questions. I mean, I think in terms of the risks related to a rise in interest rates, obviously at some point it will have an impact in terms of asset quality, so debt affordability will reduce. But we are coming from very low levels. So I think there is room to raise rates without impacting asset quality. When you talk to bank managements before, they've typically said, when rates get to 4 to 5%, you start to see more of an impact in terms of asset quality, more of an impact in terms of debt affordability reducing. So, I think we are in a position in which, should they raise rates from here, from where we are, sort of ultra low levels, asset quality will remain resilient, we think, and should be supportive to earnings. So I don't think we need to worry about the asset quality element of it until we get to 4-5% of interest rates. Should they not be able to raise rates and we move into a more of a sort of stagflationary environment, we get maybe higher inflation but moderation in growth. Obviously that is not as positive an environment for the sector, nor would it be for the overall markets. You are like to see some cost inflation come through. You're not going to get the same level of earnings uplift from higher rates. I think if we look at previous examples of stagflation as an example, so looking at the 1970s, it wasn't a good period for markets overall, but actually the banks outperformed the broader market in all years apart from two within the 1970s. So, it's clearly not as positive in a market environment, but on a relative basis, actually, the banks typically out.
So apart from the Bank of England Monetary Policy Committee, the other meeting going on at the moment is COP26. We've had some talk of kind of an agreement to end the financing of fossil fuels by global banks. And then we've also had our Chancellor's talk of making the City of London, in particular, finance a net zero contributor, if you like. What are your thoughts on what this means for the banking system?
Yeah, it's an area that we are seeing more attention focused on it. I would say this is an area where disclosure for the sector is going to have to improve materially, because at the moment it can be a bit patchy in terms of comparing loan books and seeing who's exposed in what areas. But the direction of travel is clear. In one sense, it's clearly an opportunity. You are going to need to have a lot of investment to transition what is a fossil fuel based economy towards a renewable green based economy, and that's going to take a significant amount of growth, and that will be an opportunity for banks to be part of that, to lend into that transition. So some estimates suggest that could raise annual loan growth by about 200 basis points each year. And then within the sort of regulatory side of things, it is a risk if you are heavily exposed to fossil fuel type borrowers. And we are likely to get some changes in regulation. It's still not clear what they might be, but they could amend the risk-weighted assets for companies exposed to carbon-intensive industries. And on the other hand, maybe they would reduce them for more sort of green, renewable type industries. So there's likely to be some regulatory changes to encourage that transition. But I would say we're just at the start of this sort of process in terms of disclosure. And so we are taking the opportunity to raise this in meetings we have with companies, that we need to get better disclosure to sort of improve that comparability between different companies. But it's going to become an increasing theme for the sector going forward.
Going back a bit to the sort of the issue of growth versus value. So I suppose the financial sector is clearly a classic value sector. There are perhaps some growthier, use a horrible word, areas within the sector. Is that a part of how you think about your portfolio? Are you worried about being too exposed to the value factor per se? Do you think about trying to moderate that with your fintech or your mid-cap exposure?
Yeah, and I think we have an income and growth mandate. So we look globally, look at opportunities across all of that. So right at the moment, we are seeing opportunities to get very attractive yields in areas where maybe there's not as strong growth, but it's a balance in the trust. So we look to also balance that out with having exposure to emerging markets, where, as noted, we can find high levels of loan growth, strong levels of profitability. We had the slide earlier in terms of US small mid-cap bank loan growth averaging 20% year on year. We could also put stocks like One Savings Bank in the UK, which is a specialist mortgage lender, again has sort of high teens level of growth. And then you add on sort of fintech element as well, which is clearly a growth part of the sector. So it's a balance of the two, and just trying to think where we are in terms of the economic cycle, and where the most attractive opportunities are. But I think going forward, we would look to keep that balance, to offer investors that capital growth, but also some dividend yield as well. Sorry, Thomas, you're on
You're
mute.
muted, Thomas.
Apologies. I just wanted to say to the audience that if you wanted to put a question, please, I think this is your last opportunity. So you had a bit of a left field question, if you like. So we discussed fintech. What about crypto? Would you consider investing in companies in this space? I can think of one investment trust that made good money with a Bitcoin investment at the turn of the year. It was relatively short-lived, but is that an area that you would consider?
Yeah, I mean, we wouldn't invest directly in crypto, but we have exposure indirectly. So we have exposure to PayPal. So these types of wallets are going to be more involved in terms of crypto trading. And we have exposure to something called Signature Bank in the US, which is able to has a platform for taking crypto deposits as well. So it's kind of integrated and a key part in terms of the growth of crypto trading, and it benefits in terms of a cheap source of funding. So there are indirect areas that we can look to play that theme. There are the exchanges as well, something like a Coinbase, which we would look at, but we wouldn't have it's too speculative to have pure exposure to crypto as is. But if there's a way of getting exposure to it in an indirect way, which we think is attractive in terms of risk reward, we would certainly look at
it. In a positive scenario where we get rate rises and bank profitability improves, do you think the temptation will be for governments to whack taxes up? I can't remember when the windfall tax was, but you could foresee perhaps a similar attempt by the Chancellor, given the state of the public finances. Do you think that's an issue in the UK or in other major markets?
Well, I mean, most recently we've seen the Chancellor willing to reduce the bank surcharge in the UK, and I think that was quite a big step to actually show, following many years of banks being a source of higher taxation, to actually go in a different direction. I think there's always a temptation to tax the banking sector when it might have supernormal profits, and it can be a vote winner. But I think we are in a different environment in that, following this downturn, the banking sector wasn't a source of instability. Actually, it was a source of, of recovery and a means for the government to support, the growth and recovery of the economy. So I don't think that the same sort of appetite to tax the banks and to look for redress and fines in the way that there was after the financial crisis. You can never say never, but I think the regulatory environment is certainly much more settled than it was before. We now have visibility on long-term capital requirements, the full implementation by 2030. That gives bank managements confidence to pay down surplus capital. It feels very different in terms of the atmosphere on regulation. In terms of what they do on taxation, it's a little bit more unpredictable, but it doesn't feel like there's such an appetite to tax the banks. Conversely, we are seeing more consensus about taxing other sectors, such as the technology sector, which has been able to have relatively low taxation rates given where it's been domiciled. So we are seeing, the focus shift to other sectors from where it was. And we have to think that we are now 12 years after the financial crisis. The sector has moved on. It's contributed towards, high levels of taxation, deposit guarantee funds, and it's been a long time since the financial crisis.
What about the asset management industry? Is that an area that you can invest in? We've had one question asking, given they've done very well in recent years, quite asset light and cash generative businesses. Is that an area that you would be interested in owning more of?
Yeah, we have some exposure. I mentioned Banca Generali in Italy, which has continued to show very strong AUM growth. I think in Italy it's an interesting example of where the growth is much stronger there because you have a transition of household savings from government bonds into managed products, and that supported very strong AUM growth for players like Banca Generali. but that's not really replicated in other areas in the sort of traditional asset management industry, which have seen certainly fee income pressure, fee margin pressure weigh on earnings. But there are areas of interest certainly for us, and within the alternative space, we have exposure to Blackstone. The fundraising there remains really incredible. We continue to see very strong growth in terms of AUM growth. Relative returns compared to other areas as well remains attractive. So you can continue to see the net flows within the alternative space outpacing the more traditional areas of the industry. And I think our weighting and our exposure is likely to remain biased towards alternatives. We have a small exposure within something called Gresham House, which is a asset manager within the sort of renewables, ESG focused areas. They have hard assets focused on forestry and batteries. Again, that's an area that's seeing a lot of flows and strong returns. So I think it's about sort of choosing the areas within the industry that those that are able to defend their sort of margin pressure by being a bit more differentiated and can see the sort of stronger flow trends because focused within those areas of alternatives.
Great, and I think a final question we've got time for. So we touched on crypto. Major potential part of that ecosystem is central bank digital currencies. Is this an opportunity or a threat for banks' businesses?
Yeah, that's a great question. I think early days, but clearly there is a lot of interest in central banks introducing this, and we're seeing this across Asia and Europe and the US. I mean, as it currently stands, it likely to be some flow of deposits from the banking sector to central banks. That could raise funding costs for the banking sector, but again, we don't know the cap that they're likely to put on it. I mean, from some of the white papers that we read, suggests about a 2,000 to 3,000 euro or pound cap on deposits that you could keep from the central bank. That could lead to some increase in terms of funding costs for the banking sector. We've seen some estimates that could be a 2 to 3% impact in terms of net interest income. However, I would say it would be unusual for the regulator to do something that would destabilize their own banking sector. So whatever they would introduce, I think it would be in a way in which it would be in line with promoting financial stability. So we're at the sort of early stage of it. I think it's likely to come in some form. Directionally, I think it could be a sort of a modest negative for the sector, but we'll have to wait and see on the details. Longer term, though, I mean, there obviously are other ways to play that, and that is the digitalization of payments overall. And that is clearly accelerating because of COVID. And we look to play that through the payment companies such as PayPal, MasterCard, Adyen, and others. So, there are obviously ways to play what will be, what is becoming an accelerating transition from physical to digital cash and payments.
Brilliant. Well, thank you very much, George, for your interesting presentation and for taking all the questions. And thanks to the audience for your participation. We will shortly be hearing from Zara Osmani, manager of Martin Currie Global Portfolio, if you'd like to stay on for that. So once more, I'd just like to thank George and say goodbye.
Thank you very much.